Our group has chosen Apple and Microsoft because both companies are global leaders in the technology industry today. Apple Incorporation was founded on 1st April 1976 by Steve Jobs, Steve Wozniak, and Ronald Wayne. Since its inception in garage in California, Apple has become one of the best technology companies that have made great contributions in the manner in which people communicate, work, and handle digital media.
Another company that we choose is Microsoft Corporation. Microsoft is an American multinational technology company founded on 4 April 1975 by Bill Gates and Paul Allen, with the initial goal of developing software for personal computers. Microsoft began in New Mexico but later moved its headquarters to Washington State, where it grew rapidly. Microsoft has now become the biggest software company and also one of the most valuable companies in the world.
Capital structure refers to a mix of funding a company uses to finance its operation, investment, and growth. Specifically, the proportion of debt and equity in financing. The balance between debt and equity often measured through gearing and leverage. Determine a financial firm risk and cost of capital, and company aim to achieve an optimal capital structure that minimizes financing costs while maintaining financial stability. Based on the calculation, the gearing in 2022 showed that total debt were 120,069 million. Total shareholder equity was 50,672 million, and therefore the gearing ratio was 237%, calculated by dividing total debt by total equity and multiplying by 100%. In 2023, total debt decreased to 111,088 million, while total shareholder equity increased to 62,106 million, resulting in a lower gearing ratio of 178.7%. In 2024, total debt were 106,629 million, and total shareholder equity was 56,950 million, producing a gearing ratio of 187.2%. Based on the calculation, the gearing ratio in 2022 showed that total debt were 49,781 million. Total shareholder equity was 166,542 million, and therefore the gearing ratio was 29.9%, calculated by dividing total debt by total equity and multiplying by 100%. In 2023, total debt decreased slightly to 47,237 million, while total shareholder equity increased significantly to 206,223 million, resulting in a lower gearing ratio of 22.9%. In 2024, total debt increased to 49,381 million, while total shareholder equity rose further to 268,477 million, producing a gearing ratio of 18.4%. Apple high gearing reflects a deliberate capital allocation strategy that prioritizes shareholder return over balance sheet conservatism, using substantially low debt to fund large share buyback and dividend without issuing new equity, thereby augmenting EPS and return on equity while relying on its very strong operating cash flow and cash reserve to service interest and principal. As a result, Apple profit is better suited to investors seeking higher return potential from capital return program and willing to accept higher financial risk rather than those focused primarily on capital preservation. Microsoft low gearing signals a conservative capital structure that minimizes financing rate, limit exposure to interest rate movement, and preserve the capacity to undertake less acquisition or absorb economic shock without distressing financing. For investors, this makes Microsoft more aligned with capital preservation and steady growth, adaptive, turning off the potentially high EPS from aggressive buyback in favor of liquidity, flexibility, and lower default risk during economic downturn.
Dividend refers to payments made by companies to shareholders from their profits. Dividends can make the company shares more attractive to investors because they provide regular income. However, high dividend payments may also indicate that a company is not reinvesting in the profits for future growth. Dividends can be paid in cash or in stock. Company may issue regular dividends quarterly, semi-annually, or annually. or special dividends in addition to regular ones. There are also liquidating dividends, which are treated differently from debt purpose. Next, dividend policy refers to a company decisions on how much profit to distribute to shareholders and how much to retain for reinvestment. There are several types of dividend policies. The reciprocal policy pays dividends after all investment needs are fulfilled. A stable dividend policy ensures consistent payments over time. A progressive policy increases dividends annually, while a constant payout policy maintains a fixed payout ratio. Companies may also declare interim dividends during the year and final dividends at the end of the financial year. Now, looking at Apple Incorporation, the company follows a stable and gradually increasing quarterly cash dividend policy since 2012. Apple combines dividend payments with large share buybacks programs. This approach provides consistent returns to shareholders while maintaining flexibility for innovation and expansion. Overall, Apple's policy is conservative and focused on long-term value creation. On the other hand, Microsoft adopts a more conservative dividend policy with a strong focus on dividend reinvestment. Although it pays quarterly dividends, it allocates significant profits to research, development, and acquisitions. This strategy supports innovation and long-term earning growth, benefiting shareholders through capital gains and stable dividends.
Now, I will talk about Mulyani and Miller theory on dividend policy and how it relates to the dividend practice of Apple and Microsoft. MMM theory was developed by Franco Mulyani and Merton Miller in 1958 and later extended to dividend policy in 1961. In practice, Apple and Microsoft did not strictly follow the MMM dividend irrelevance proposition during their early high growth stage. Apple, for example, did not pay dividends between 1995 and 2012. When Apple resumed dividend payments in 2012, it was a strategic move aimed at attracting institutional investors and signaling financial maturity and stability. Similarly, Microsoft did not pay dividends during its rapid growth phase. It only initiated dividend payment in 2003, which signaled a transition from a high-growth company to a mature firm with a strong and stable cash flow. This decision suggests that dividend policy in reality carries signaling value and is influenced by investor expectation, which contradicts the core MMM theory.
Moving on to the calculation and interpretation of dividend payout ratio of Apple Incorporation. In 2022, earnings per share was 6.15 cents. Dividend per share was 0.93 cents with calculation of dividend paid divided with number of shares. Dividend payout ratio was 15.12% with calculation of dividend per share divided by earnings per share. And the dividend growth rate is negative 2.58% with calculation of D1 minus DO over DO of the dividend payout ratio. In 2023, earnings per share was 6.16 cents. Dividend per share was 0.97 cents. Dividend payout ratio was 15.75%, and the dividend growth rate was 4.17%. And lastly, for 2024, earnings per share was 6.11 cents. Dividend per share was 1 cent. Dividend payout ratio was 16.37%, and dividend growth rate is 3.94%. Moving on to the Microsoft Corporation. In 2022, earnings per share was 9.70 cents. Dividend per share was 2.47 cents with calculation of dividend paid divided by number of shares. Dividend payout ratio was 25.46% with calculation of dividend per share over earnings per share. And the dividend growth rate is negative 7.72% with D1 minus DO over DO of the dividend payout ratio. In 2023, earnings per share was 9.72 cents. Dividend per share was 2.72 cents. Dividend payout ratio was 27.98%. Dividend growth rate was 9.89%. In 2024, earnings per share was 11.86 cents. Dividend per share was 2.99 cents. Dividend payout ratio was 25.21%. Dividend growth rate was negative 9.9%.
Apple dividend performance over the 3 years reflect a steady and cautious dividend policy. ETR rising from 2022 to 2024 indicates that a slightly larger portion of earnings is being distributed as dividends each year, even though earnings were relatively stable. The slowing dividend growth rate suggests that Apple is transitioning toward a more sustainable and conservative dividend strategy, likely to preserve earnings for reinvestment and future growth opportunities. Overall, Apple's approach balances shareholder return with financial prudence, showing that the company aims to maintain predictable dividend payment while supporting long-term corporate stability and strategic investment. From an analytical perspective, Microsoft's dividend performance over these 3 years demonstrates both strong profitability and a proactive shareholder return strategy. The steady increase in dividend shows that management commitment to rewarding shareholders while maintaining financial flexibility. The dividend payout ratio, which remained within the range of 25 to 28%, suggests that Microsoft effectively balances dividend distribution with retained earnings for reinvestment. This approach allows the company to support long-term growth while still offering predictable income to the shareholders.
The weighted average cost of capital, or WACC, represents the average cost a company pays to finance its operation using equity and debt. It is calculated by weighting the cost of equity and the after-tax cost of debt based on their market values. WACC is important because it acts as the minimum required rate of return.
Moving on to WACC calculation for Apple. In 2022, the cost of debt is 2.44%, the cost of debt after tax is 1.85%, the cost of equity is 10%, the market value of equity is 2,398,369 million, market value of debt 1,200,69 million, the weightage of equity 95%, and the weightage of debt is 5%. The total WACC for 2022 is 9.59%. In 2023, the cost of debt is 3.54%, the cost of debt after tax is 2.69%, the cost of equity is 9.94%, market value of equity is 2,662,325 million, market value of debt 1,110,88 million, weightage of equity 96%, and weightage of debt 4%. The WACC in 2023 is 9.65%. In 2024, the cost of debt is 2.72%, the cost of debt after tax is 2.07%, the cost of equity is 10.04%, market value of equity is 344,3452 million, market value of debt 106,329 million, weightage of equity 97%, and weightage of debt 3%. The WACC in 2024 is 9.8%. Now, let's take a look on Microsoft WACC calculation. In 2022, the cost of debt is 4.14%, the cost of debt after tax is 3.15%, the cost of equity is 9.95%, the market value of equity is 1,916,979 million, the market value of debt 49781 million, the weightage of equity is 97%, and the weightage of debt is 3%. The WACC in 2022 is 9.75%. In 2023, the cost of debt is 4.17%, the cost of debt after tax is 3.17%, the cost of equity is 9.88%, market value of equity 2,530,893 million, market value of debt 47237 million. The weightage of equity is 98%, and the weightage of debt is 2%. The WACC for 2023 is 9.75%. In 2024, the cost of debt is 5.68%, cost of debt after tax is 4.32%, the cost of equity is 9.86%, market value of equity 3,322,626 million, market value of debt 5.630 million, the weightage of equity is 98%, and the weightage of debt is 2%. The WACC for 2024 is 9.75%.
For Apple, the increase in the cost of debt in 2023 was mainly due to interest rate hikes, which raised borrowing costs. However, in 2024, Apple managed this well by reducing its debt and investing excess cash into high-yield marketable securities. As a result, Apple's WACC remained stable, increasing only slightly from 9.59% to 9.80%. This stability is largely driven by Apple's large equity base, with the cost of equity by staying close to 10%. Strong investor confidence supported by Apple's share price remaining above its 200-day moving average and a $110 billion share. For Microsoft, the company maintained a constant WACC of 9.75% for 3 consecutive years. Despite its cost of debt rising to 4.327% in 2024, this increase was due to heavy borrowing for AI and data center investments. However, positive market response to Microsoft AI strategy lowered its perceived risk, slightly reducing its cost of equity to 9.86%. As a result, Microsoft successfully offset higher debt costs and maintained strong capital discipline.
To make it simple, Apple is high leverage, which focus on shareholder buybacks and capital efficiency, while Microsoft is low leverage, which focus on AI investment and strong direct dividend payout. Both maintain a hurdle rate near 10%, but Apple is playing a game of scale and leverage, while Microsoft is playing a game of strategic flexibility and AI momentum.